Do you know that if you buy just 100 shares of Infosys, you actually become a part owner of the company? Yes, the stock market gives you the power to own a piece of some of India's biggest businesses. Let's understand how. Welcome to Financial Insights. In this video, we will learn what the stock market is, why companies list themselves, and why people like you and me should invest. The stock market is a marketplace where people buy and sell shares of companies. When you buy a share, you become a small part owner of that company. For example, if you buy 100 shares of Infosys, you technically own a small percentage of the company. That makes you an owner of a public limited company, a company whose shares are traded openly on the stock exchange. But why do companies sell their shares to the public? The main reason is to raise money for growth. They may want to expand their business, launch new products, or reduce debt. When a company first offers shares to the public, it is called an IPO, initial public offering. Take the example of Zomato's IPO in 2021. The company raised over 9,000 crore rupees from the public. A big portion went towards growth and expansion, but some was also used to cover losses. As an investor, this is where we must ask, where exactly is the company using the extra money? Is it being invested wisely for future growth, or just to cover past expenses? This decision tells us whether we should invest or not. So why should people like us invest in the stock market? The biggest reason is wealth creation. Over time, the value of good companies grows, and so does your investment. Investors also earn dividends, a share of the company's profits. On average, Indian equities have given 12 to 13% returns per year over the last 10 years. If you include dividend income, the returns are around 13 to 14%. That's almost double of what you would get from a fixed deposit. And here's a golden rule. The longer the time frame you give to the stock market, the less likely you are to face losses. To measure the overall performance of the market, we use something called indices. The Sensex tracks the top 30 companies listed on the Bombay Stock Exchange. The Nifty 50 tracks the top 50 companies listed on the National Stock Exchange. Think of it like cricket. Sensex is like the top 30 star players of Indian cricket, while Nifty is the top 50 champions. Together, they represent the strength of the entire team, in this case, the Indian economy. So if Nifty and Sensex are rising, it means overall the stock market and economy are performing well. In the next video, we will go deeper into Sensex and Nifty, and understand how they are formed and why they matter for every investor. That's it for today's video. If you found this useful, please like the video and share it with your friends. And don't forget to subscribe to Financial Insights for more beginner-friendly investing lessons. Remember, this content is for educational purposes only, not financial advice.